for our next presentation, we have Neha Saroya, and they're going to be presenting on the impending economic catastrophe, examining the impacts of the COVID-19 pandemic on the American economy.
So I will be speaking about the economic catastrophe that has resulted due to COVID-19, specifically on the American economy. So COVID-19, otherwise referred to as coronavirus, this pandemic has impacted lives in almost every way imaginable, with over 25 million people infected and 842,000 deaths thus far. The year of 2020 will certainly take up more than a few pages in history books. While the initial outbreak is thought to have begun mere months ago in Wuhan, China, this infectious disease has since resulted in a virus that has reached 214 countries. The quick spread of COVID-19 across the globe can be attributed to the globalization of the world's economy, as well as the growing interdependence of economies, cultures, and populations worldwide. In an attempt to curb the spread of this disease, many countries mandated the closure of all in-person operations for non-essential businesses during their first wave of cases, resulting in major global economic disruptions. So this presentation seeks to assess the impacts that COVID-19 has had on labor markets around the world, with the focus on the United States of America, due to the abundant amount of statistics that can easily represent the changes in the economy since the country's first recorded case on January 20th of 2020. However, not all industries or firms within the labor market have been affected equally. Consequently, this presentation will aim to focus on the service industry, which is a sector that has been affected most severely by COVID-19, as well as small businesses, which have proven to be particularly vulnerable at this time. And in order to provide a holistic view of COVID-19's impact on the economy, this report will also discuss e-commerce, one of the few industries that has experienced increased demand in the times of social distancing. So we will begin with the labor market, followed by the service industry and small businesses, and finally ending with e-commerce. The labor market is the larger term that's used to describe interactions between employers and employees. So when considering the shutdown of many non-essential businesses due to COVID-19, it is unsurprising that there has been a large strain on the labor market. This holds especially true for the US, which has been disproportionately affected by the pandemic thus far, with almost 6 million people infected with the virus as of August 29, 2020. As a result of this pandemic, there have been historic rises in both the unemployment and underemployment rates, with the latter being defined as workers who are employed but do not receive as many hours as they desire. Those that are particularly vulnerable to losing employment at this time are individuals who were already on the margins of the labor market when the pandemic hit. This includes youth, recent immigrants, minorities, and those without tertiary level education. In March 2020, shortly after the outbreak spread to the US, yet before many businesses were forced to shut down, the US unemployment rate was 4.4%. In the span of the 2 months that followed, the unemployment rate rose to 17.8% by the end of April 2020, which includes the 22 million individuals who filed for unemployment insurance within the month as well. Although by July, the unemployment rate fell to 10.8%, with 1.8 million jobs being added as businesses began to open up once again, there are still millions struggling to get by as their hours are reduced or there's simply no employment available. The U.S. Department of Labor is responsible for processing these unemployment insurance claims, and they also publish the number of workers who file claims on a weekly basis. And the statistics released by this department greatly aid the understanding of the drastic effects that COVID-19 has had on the American labor market. The state of Ohio reported 78,000 uninsurance employment claims in only 3 days during the third week of March, which was a 2,579% increase from the week before. Meanwhile, the state of New Jersey reported receiving over 200,000 unemployment insurance claims in the last week of March. So to put that in perspective, the week that Hurricane Sandy hit New Jersey in November 2012, there were 46,000 unemployment insurance claims. and there was an estimated economic loss of 11.7 billion in state GDP. This excludes recovery and reconstruction expenditures. So this devastation has been felt across various sectors of the labor market in an unprecedented manner. In March 2020 alone, the U.S. Commerce Department estimated that retail and food services fell 8.7%, which is the biggest decline to date. And industrial production in the U.S. also fell 5.4% in the same month. This makes it the largest drop since the shutdown of the wartime economy in 1946. And ultimately, the shuttering of businesses, coupled with the decreased manufacturing output related to the jump in unemployment, can be correlated to the vast number of supply chain disruptions, which is exacerbated by the global nature of today's economy. And during a time where profits are already suffering, these disruptions are likely to increase manufacturing costs for businesses, thus deepening their expense line and making it more difficult to maintain the skeleton staff they were still able to keep on hand. Now, moving on to the service industry, as previously mentioned, the consequences of the COVID-19 pandemic on the labor market are not equally distributed amongst the different industries. In many service-oriented sectors, much of the regular service output is being lost as people cancel their usual activities, such as visiting the salon, the dentist, or even just going out to eat at a restaurant. And despite businesses now beginning to open up, these service-oriented sectors now have reduced capacity due to mandated social distancing, as well as a huge drop in business, as many are still hesitant to resume their normal activities. And due to the in-person nature of these businesses, the loss of sales during this time will never be recovered. Industries that rely on in-person services, such as traditional retail shops, are much less likely to recuperate following the pandemic than industries that are less reliant on face-to-face delivery of services. Small businesses, which are defined as those with less than 500 employees, are especially vulnerable because many are unlikely to recover from the loss of sales due to a lower threshold to absorb the loss. In addition, the longer the mandated closures last, the likelihood of said businesses being able to reopen drastically decreases. A survey that was conducted by the National Bureau of Economic Research found that if business closures in the US lasted 1 month as opposed to 4, 72% of small businesses could be expected to reopen by December 2020. However, if there was a 4-month closure, only 47% of businesses would be expected to reopen by the same time. Although these small businesses employ almost 50% of workers in the US, most of these firms do not have the appropriate cash flow to be able to survive more than 1 to 2 months of closure without incoming revenue. Now, this histogram outlines how many months each of the surveyed firms could sustain themselves without taking out loans or borrowing money from family. Given that many non-essential businesses did not start opening until 3 to 4 months after closure, it is evident that some businesses may not recover from the pandemic, as the majority of them only have the cash flow to sustain themselves for 1 to 2 months without revenue. This trend of small businesses being more vulnerable during the pandemic is similarly evident when contrasted to conditions within Canada. According to Statistics Canada, 32% of businesses with over 500 employees have reported a more than 20% decrease in revenue since closures began. And these figures drastically increase when looking at businesses with only 5 to 19 employees, with 56% of them reporting the same decline. Now, when examining those with 1 to 4 employees, this figure continues to rise to 60%. And it is clear that despite their efforts, many small businesses lack the resources and cash flow required to survive this pandemic if lockdown continues, which holds particularly true for businesses in the service sector. Now, moving on to e-commerce, this is virtually one of the only industries that has actually managed to experience growth during the time of the COVID-19 pandemic. While most traditional retail stores faced mandated closures, apart from those supplying necessitated goods such as groceries, coupled with a population that has been limited to only essential outings, individuals are looking for new methods to access their everyday goods. As a result, many people had drastically increased the amount they spend on online shopping, even in a time where many are losing their jobs or experiencing a reduced amount of income. In the US, retailers' growth in online revenue hit 68% during April 2020, which is an approximately 20% increase from the growth reported in January 2020 prior to the pandemic. Furthermore, as of April 21st, just 4 months into the year, the number of both American and Canadian e-commerce orders have soared, resulting in a 146% increase from 2019. While this growth is certainly unexpected, it stems from the unprecedented situation of firms needing to account for their loss of in-person sales through an increased online presence, combined with the limited traditional retail options that were available to consumers in the past few months. This figure depicts how quickly COVID-19 has changed the retail industry. The percentage of retail sales via e-commerce in the US quickly rose from 11% to 27% from March to April 2020. To put this increase into perspective, it took 10 years for these figures to reach 16% from the initial 5.6% of sales reported in 2009 in the wake of the 2008 economic downturn. These new habits may become permanently ingrained within consumer behavior in the post-pandemic world as large amounts of the population become adjusted to this new lifestyle and companies continue to invest in their e-commerce infrastructure to address gaps uncovered by the current situation. So to conclude, the majority of the economic changes seen as a result of COVID-19 have rapidly evolved within a matter of months. As the first wave of this virus comes to a close in North America, it is yet to be seen whether there are a vast number of changes to transpire. But thus far, the economy has been impacted with a sizable reduction of the labor force, a particularly hard-hit service industry due to social distancing policies, and seemingly fatal blows to the survival prospects of small businesses. Despite the numerous negative economic downturn trends, the specific sector of e-commerce has been able to experience historic gains, and the COVID-19 pandemic seems to be far from over. As previously stated, it is still unclear what further developments could occur for the economy. While many areas are still focused on weathering the current storm and rebuilding efforts remain yet to be seen, it is clear that given the sheer devastation experienced thus far, the scale of this crisis could be unlike anything seen in modern times. Furthermore, this pandemic has revealed many gaps within the economic system, ones that will undoubtedly be addressed following its conclusion to prevent catastrophe on such a scale from ever happening again.
Thank you so much, Neha. That was awesome. Neha, Zach is wondering, can small businesses and service industries work around the virus, or are they doomed without a vaccine? Does a saving grace lie in rethinking their business model into an electronic version?
There's definitely a lot of businesses that have tried to move to an electronic version in order to try and keep some of their revenue. The problem with most small businesses is that they don't have the funds to efficiently do so. A lot of small businesses rely on the locals in their community coming and purchasing goods from them. But in order to completely take the business online, there's a lot of monetary factors to consider, such as purchasing a website domain and also paying for marketing, which is one of the main costs. And given that many businesses have already lost so many months of revenue, it is not feasible for a lot of them to try and move online because they also don't know what the outcome of that would be. They don't know if they would get a large amount of orders through that. So it's definitely feasible if you have that type of cash flow, but for businesses that don't, it's not exactly something that they would be able to do at the moment.
Yeah, those are some good thoughts. Thank you for that, Neha.